In recent times, Canada has made bold moves that have shaken the U.S. economy, and these actions are reshaping the trade landscape between the two nations. One of the first steps was Ontario's decision to cancel its contract with Starlink and ban American companies from bidding on government contracts. Ontario spends about 30 billion Canadian dollars annually on government contracts, making this a financial blow to U.S. firms seeking access to that market. This decision is more than symbolic. It signals that Canada will not allow the U.S. to dominate its market unchecked. Ontario's actions show Canada's willingness to stand firm against U.S. economic influence, a clear shift in policy. The U.S. accounts for over 76.88% of Canada's exports, so this is a major shift in Canada's trade policy. The next blow came with the LCBO, the world's largest liquor store, halting imports of American alcohol amid new U.S. tariffs. American producers lost over $965 million in a single day, a sharp blow for U.S. alcohol exporters. In 2023, Canada imported over $1.1 billion worth of alcoholic beverages from the U.S., and this change has caused substantial losses. Furthermore, Canada imposed a 25% tariff on $155 billion worth of U.S. goods, affecting everything from farm products to household appliances. For example, U.S. car manufacturers were hit with tariffs on $28 billion in vehicle exports, raising costs for consumers on both sides of the border. These added fees are already making many products more expensive, signaling a ripple effect across the economy. Beyond tariffs, Canada is stepping up in the energy sector and making itself a critical player in global energy. U.S. tariffs on Canadian natural gas have raised prices by 10% in the U.S. market, leading to higher energy bills for American households, potentially by as much as $150 per year. Meanwhile, Canada is positioning itself as a reliable energy supplier to countries looking for alternative sources. The LNG Canada project, which is expected to deliver up to 14 million tons of natural gas annually once operational, is one of Canada's biggest energy investments. The project will help solidify Canada's role as a key energy exporter on the world stage. Canada's geographic advantage plays a crucial role here. Not only can it ship natural gas across the Atlantic to Europe, but it also has access to the Pacific, allowing Canada to tap into both European and Asian markets. This multiple route strategy gives Canada a competitive edge over others. At the same time, the U.S. LNG market has been losing ground. Over the past 2 years, the U.S. saw a 15% decline in its LNG market share, and Mexico is expanding its LNG capacity by 20% in the next decade. With growing competition, Canada is capitalizing on these opportunities to strengthen its position in global energy production. This shift is reshaping how countries approach energy production and pushing them to adopt smarter, more flexible strategies. The impact of these changes is not limited to trade and energy. U.S. industries are facing tough times as they try to adjust to the tariffs, shifting policies, and increased competition from Canada. U.S. businesses must decide whether to absorb losses or press for changes in U.S. policies to reverse the damage caused by Canadian tariffs. One of the hardest hit sectors has been agriculture. U.S. farmers have lost over $13.2 billion in 2018 and 2019 in exports to Canada, as tariffs on agricultural products raised prices for Canadian consumers. The auto industry has also felt the pressure. Canada accounts for nearly 20% of U.S. vehicle exports, and with tariffs in place, this trade is becoming less profitable. The U.S. automotive sector is already bracing for losses from these tariffs. On the flip side, Canadian consumers are increasingly choosing local products in response to the rising tariffs. Surveys show that 85% of Canadians are now opting for Canadian-made goods over U.S. imports. This shift is creating opportunities for Canadian manufacturers and boosting the local economy. As tariffs raise the price of goods in Canada, more and more consumers are opting to support homegrown industries. For example, Canada's retail sector has seen a rise in demand for locally made products, which is benefiting businesses across the country. Meanwhile, tourism is another area where the impact is being felt. With tensions high, Canada's tourism to the U.S. dropped by 7% in 2024, costing U.S. states that depend on Canadian visitors around $1.5 billion in lost revenue. This decline in cross-border tourism is a direct result of the economic and political climate. The growing tensions between Canada and the U.S. have fueled a grassroots boycott movement in Canada. Many Canadians are boycotting U.S. products to protest U.S. trade policies, and this movement is more than just rejecting goods, it's a show of national pride. Canadians are standing firm in their belief that the U.S. needs to respect Canada's sovereignty. The impact of this boycott is already visible in the U.S., especially in states that rely heavily on Canadian tourists. Canadian tourists account for around 15% of total international visitors to the U.S., and a small drop in Canadian tourism is costing U.S. states like Florida and New York over $1.5 billion annually. The alcohol industry is feeling the effects too, with sales dropping 20% in Canada for popular U.S. brands like bourbon and whiskey. This boycott movement is not only economic, but also deeply cultural. It is about preserving Canadian values and asserting independence. Canadians are choosing local products and canceling vacations to the U.S. to show solidarity with the movement. In a 2024 survey, nearly 85% of Canadians reported they were more likely to purchase Canadian-made goods due to the tensions with the U.S. The shifting trade dynamics are not limited to just North America. China has increasingly turned to Canada for oil, natural gas, and agricultural products, pivoting away from the U.S. Due to rising tensions, this shift is a major blow to U.S. businesses. In 2024, U.S. exports to China dropped by $12 billion, and much of this loss has been absorbed by Canada. Canada's oil exports to China have skyrocketed, with upgraded pipelines now moving nearly 3 times as much oil each day. This is a crucial development for Canada's economy, as China seeks a more stable and reliable source of energy. This shift is also having a significant impact on U.S. oil companies, who are seeing their market share erode as China chooses Canadian oil over U.S. exports. In addition to oil, China has dramatically increased its imports of Canadian liquefied natural gas (LNG). The LNG Canada project is expected to begin operations in 2025, and China's LNG imports from Canada grew by 25% in 2024, further diminishing U.S. LNG exports. Meanwhile, in agriculture, China has also reduced its purchases of U.S. soybeans, wheat, and corn, opting instead for supplies from countries like Brazil and Argentina. As a result, U.S. farmers are facing a surplus of goods, driving down prices and causing $3 billion in lost revenue annually. This disruption is challenging for U.S. agriculture, as the Chinese market has long been a major buyer of American crops. The evolving trade tensions between Canada and the U.S. are more than just a passing disagreement. These actions are fundamentally reshaping the global economic order. Canada's bold moves are sending a clear message. The country is no longer willing to accept economic policies that undermine its sovereignty and interests. From tariffs on U.S. goods to expanding energy markets to building strong ties with China, Canada is positioning itself as a more independent player in the global economy. As a result, everyday consumers will feel the impact, whether through higher prices, changing markets, or new economic opportunities. In 2023, Canada's exports exceeded $5 billion, and it is clear that these shifts are driving economic change on a massive scale. For both Canadians and Americans, the consequences are significant. The changes are forcing both countries to adapt, and as China's new alliances with Canada and Europe deepen, the U.S. risks falling behind. This conflict isn't just about trade, it's about redefining the power dynamics in global commerce. The U.S. now faces an uphill battle to reclaim its place in the global market, and the next few years could be pivotal in shaping the future of international trade. Thanks for watching. Don't forget to like, subscribe, and hit the notification bell so you don't miss any updates on this evolving story. Piling gold, with over 100 tons added in 2023 alone. Similarly, Russia has been diversifying its reserves, selling oil to countries like China and India in currencies other than the dollar. Moreover, Japan, largest buyer of U.S. treasuries, has started to sell off U.S. bonds as an action to lower interest rates in the country. If this trend continues, we could see the dollar lose its status as the global reserve currency, leading to higher interest rates and volatile oil prices. The ripple effects would be felt globally, impacting everything from fuel costs to international trade. The tension between these two nations could be the beginning of a new financial era where the dominance of the U.S. dollar is no longer guaranteed. What does this mean for you? Higher costs, greater instability, and a financial system that is far more unpredictable than ever before. Stay tuned as we break down the forces at play and how this shift might impact your daily life. For decades, Japan has been one of the largest buyers of U.S. treasuries, supporting America's financial stability. However, this trend is now reversing. Japan's government has recently embarked on an unprecedented sell-off of U.S. bonds. This shift is primarily driven by higher interest rates at home. In March 2024, Japan's Bank of Japan (BOJ) raised interest rates for the first time in 17 years, signaling a significant change in its monetary policy. The BOJ's decision to end its negative interest rate policy is a reflection of Japan's desire to strengthen its economy and regain control over its financial situation. Japan's growing defense, spending, and economic revitalization plans under Prime Minister Shigeru Ishiba require more liquidity at home. Moreover, Japan is increasingly uncomfortable with the U.S. foreign policy. Especially in the Asia-Pacific region, Japan's strained diplomatic ties with the U.S. over its aggressive stance toward China have added another layer of complexity to this shift. Selling off U.S. bonds isn't just an economic decision, it's a strategic hedge against rising regional tensions. As a result of Japan's sell-off, the global bond market is being shaken. This could lead to increased borrowing costs for countries and businesses that rely on U.S. debt, affecting everything from home loans to auto loans. In particular, interest rates on loans and mortgages may rise, making it more expensive for individuals to finance major purchases. Now, let's look at Saudi Arabia, a key player in the global oil market. For decades, Saudi Arabia has maintained its oil trade exclusively in U.S. dollars, reinforcing the so-called petrodollar system. However, recent developments indicate that this partnership may be weakening. In 2023, Saudi Arabia signed a series of major trade and energy deals with China, including discussions on accepting the yuan for oil transactions. If Riyadh decides to price oil in yuan, this would directly challenge the petrodollar system and could have profound implications for the U.S. dollar. The political tension between the U.S. and Saudi Arabia, especially over issues like human rights concerns and disputes regarding OPEC production cuts, has strained their alliance. On the other hand, China offers a more stable trade partnership with fewer political strings attached. If Saudi Arabia moves forward with yuan-based oil pricing, it would send a clear signal to other oil-producing nations to diversify their reserve currencies, further challenging the dollar's dominance in global trade. The implications of Saudi Arabia's decision could be far-reaching. If the petrodollar system collapses, the price of oil and energy could become more volatile, potentially leading to fluctuating gas prices. People around the world could feel the impact through higher transportation costs, inflation, and economic instability, especially in countries dependent on oil imports. Another factor eroding the U.S. dollar's dominance is the rise of alternative reserves. For years, the dollar was seen as the global reserve currency, but this is no longer the case. Central banks around the world have been stockpiling gold at record levels. According to the IMF data, global gold reserves reached an all-time high in 2023. For example, China added over 225 tons of gold to its reserves as part of its strategy to reduce its reliance on the U.S. dollar. Similarly, Russia and India have also been boosting their gold reserves. In addition to gold, countries are increasingly exploring the potential of cryptocurrencies and digital currencies. Countries like El Salvador have adopted Bitcoin as legal tender, while others are experimenting with central bank digital currencies